So you can see cash flow, balance sheet is still balanced. But as I said, that 15,000, we could have decided to recognize it in period one and just forget about it. But what we'll be doing is we will be overeating our income, because it's going to eat into our income and just give us just one huge net loss. So imagine you bought an asset of $5 million, right? And you just look at your financial statement in that period and you see that huge loss. Whereas that's not what's supposed to be, because that asset, you are using it. Not as if you use it in year one and you forget it. And that's where depreciation now comes into play. So depreciation is more like we saying, yes, we've recognized this asset in year one, and we've even taken our cash out and paid in full. But you know what? We still need to expense this. So which means we are saying in year one, this is the portion. So yes, we paid $15,000, but in real time, right, the money worth of it is what we use in period one. The same thing, period two. And that's what depreciation is saying. So depreciation is saying, yes, we've recognized the assets coming in. We've recognized that we pay the full cash. But you know what? Yes, we're supposed to have expensed it and just forget about it and move on. But we cannot do that, because it will eat too much into our profitability stand. So which means we are still going to recognize it as an expense, but it will now be over the lifespan as we are using it. So which means I come in here, right? And I'm saying this 15,000. So I've just equal to, so let me sum this together here. So we have a waterfall depreciation chart that we usually create for our normal debt schedule, but I'm just keeping this simple, right? So which means this 15,000 divided by 5 years, right? And I can bring this equal to, just keep this constant across board. So which means instead of this whole 15 million to have eat our expense and giving us a net profit stand, I say, you know what, we recognize an asset, the portion that we use in year one, we recognize it as but remember, we've already paid for it in form of what? In form of cash. So which means instead of the whole 15 to eat this guy, let's assume our revenue is still 5,000, right? That means I'll bring my depreciation here, which means I'm expensing it over the lifespan of it. And as such, it still gives us a leverage profitability position. Right? Now, remember, we are saying we've spent this money already in year one. Right? We spent it already in year one. So let me delete this guy. We spent it already in year one. Now look at what happened. So in my cash flow now, with this expense, we've already paid for it in year one. So which means we've recognized the revenue. So it's not as if we are paying every year, we are now paying another cash of $3,000. No, we've recognized it initially. So which means it becomes a non-cash expense line item, because we've already recognized the expense in our cash flow, the whole thing in year one. But we can't do the same thing to our profit, our income statement, because it's going to eat so hard on our profit. So you can see how reasonable the profitability stand is, right? But let's assume we've recognized the whole 15,000 here. Look at what happened. Right? So that's why we said we've expensed it, but remember that we've recognized the cash initially. So which means I'll now come back to my cash flow and now add back that depreciation, because it's now a what? It's a non-cash expense that has already been recognized. So which means this 15,000, we are now spreading it over the 5 years. So we add it back because it's now a non-cash expense. Right. But now, let's take it to the next level. Now, if you come back to the balance sheet, you see that by the end of year 5, you are saying this asset is no longer in use. Now, there's some industry such that based on what accounting standard are saying, this is the asset lifespan. Immediately after that lifespan, you know what they would do? They usually sell the assets. But in most cases, it's not always like that. And you can use a personal experience. So if you're someone that has a car, so you bought a personal car. Now, the one accountant said, oh, the lifespan of this car will be 3 years. Right? Now, the main usefulness of that vehicle is to take it from your house to your what? To your office. Right? Now, before I continue my story, it's not always a good practice, a good thing for a business to have no, especially non-current, a no value non-current asset in their balance sheets. Because always remember, the first value of a business can first be seen in their assets. Which means if I want to sell this company today, what makes up the whole company is the both non-current assets that you, especially your non-current asset that you have. So we are saying, hey, my business is worth nothing. So which is not a good thing. I see modelers build models and you see at the end of year 5, nothing. Right. And remember, this is the vehicle you'll be using to supply. So which basically what you are saying is by the end of year 4, that vehicle will not be able to supply as much as it ought to supply. And here you are